economic backdrop, let's call it, seems as healthy, supportive around the world as it's been since the crisis. The word you keep hearing is synchronized growth. What I'd like to know is how you describe the macro environment right now, and specifically what signals you get from KKR's portfolio of private equity and credit investments.
Okay, all right. Well, thanks for having me. When you look around the world, so we have 120 portfolio companies. Generally, I travel about a week per month talking to CEOs and different executives. And what we see out there right now is strong growth. I would suggest Europe is probably ahead of plan. That is the area where we see monetary stimulus having the greatest impact. It is just starting to ignite the cyclical parts of the economy. When you look at earnings in Europe, the top
5 years behind America.
Yeah, but I mean, typically it's behind, but right now it's about 5 years. But remember also, in 2012, the government was contracting GDP by 150 basis points. Today, that austerity is actually a tailwind of 20 basis points. So that alone is a major growth driver. But I would get back to, we do a lot of modeling around growth. What we're seeing is a quantitative kind of ignition switch is finally turning on the cyclical parts of the economy, specifically around industrials, financials, and even some consumer businesses are doing better.
That's what I was driving at.
Yeah.
It's real.
It's real.
In other words, it's not just a bunch of numbers that people are interpreting. You see real things happening.
We do, and I would say that the other thing is that I think Draghi gave a very dovish commentary recently, essentially saying that he's going to go very slow. So when you look at rates, let's say nominal GDP, which is real GDP plus inflation, growing kind of almost 4% in Europe, and you've got a 10-year German Bund at 40 basis points. I mean, that's extraordinarily favorable backdrop.
You just came back from a trip to Spain and to the UK. What observations did you make?
I would say a little bit of tale of two cities. I mean, to me, there's a lot of noise around.
Both those countries are struggling with domestic policy issues.
They are, and I think that's the similarity. But what I would say is they're actually quite different. Next year, we think Spain could grow 2.5, 2.6%. We think the UK will be about half of that. The other thing I would say is in the UK, inflation is high. It's actually growing faster than wages. And so when we look at consumer backdrop, that's not something that we want to see, which is inflation running above incomes. And that's typically when you see pressure on the consumer, which is our base view for the UK.
Henry, here in the United States, financial conditions have been tightening.
They're actually easing, though.
Very, very recently.
Yeah.
Right? Yes.
So what's happening, though, is with rates being down until recently, credit spreads until recently being down, and then the dollar. So the Fed is in action, but to date, actually, financial conditions are easier today than when the Fed started raising rates at the beginning of this cycle.
Right.
And so our view is the Fed will continue to raise rates. I think economic growth is solid, but also you look at net worths at a record. I think there are things that they want to do to send a signal that, particularly where credit spreads are, that they're not going to leave the punch bowl at the party for too long.
Well, when you look at the backup that we saw last week in high yield spreads in particular, do you draw any conclusions from that, or is that?
I do. I mean, actually, a couple of things I would say. One is, to us, high yield spreads is one of the single biggest indicators we look at. Two is we run an implied default monitor, and before last week, it was essentially saying that the implied default rate on high yield was 1%. And just to put that in context, in January of 16, it was 8%. So the market has gotten quite constructive. So as an asset class, we have
complacent?
I think complacent's a good term. I think as a firm, we manage a lot of bank loans, levered loans. We're trafficking in that all the time. Our portfolio managers have moved into other areas right now. And that's true in Europe. I mean, if you look in Europe today, the high yield bond is yielding less than the dividend yield on European stocks. So if you just take a step back, that seems a little bit offsides to me.
Okay. At the same time, notwithstanding this backup in credit spreads, valuations, right, almost across all asset classes are on a relative basis still very rich.
I think that's the headline, but I'll give you a more optimistic view, which is this environment reminds me a lot of the late 1990s. It's not like the 2006, 2007. In the late 1990s, you had a lot of investors chasing growth and chasing kind of simplicity, and they left things that had kind of problems around them. And
the hairy stuff.
The hairy stuff, and that today is what's happening. I mean, we're 9 years into a bull market, and you still have actually over half the Russell 2000 is trading less than 10 times EBITDA. And obviously that's not cheap, but relative to a 9-year bull market, that's pretty incredible. And
people forget that stuff when they look at the valuation, the PEs on the FANG.
It's the same thing. The consumer net worth looks incredible at a record, but when you look underneath, the majority of Americans haven't had real wage growth in 2 decades. So to me, it's this whole bifurcation. Our mantra internally is kind of buy complexity, sell simplicity. The one area I'd say in the equity market, we certainly are quite constructive on Asia. Japan is a very big market for us, and we also see, I think we had talked about this last time, we've been calling for a turn in emerging markets. We now actually think we're entering a mid-cycle of the emerging markets. So, if you snooze, you'll miss it. But I mean, right now it's actually performed well. Things are happening fast. We think that will continue for the next couple of years. And implicit in what I'm saying is a view on the dollar, that we think the bull market and the dollar has largely run its course.
So you mentioned that one of your long-running themes, at least this year, is complexity over simplicity.
Yeah.
Although that probably goes back even further for KKR. But you've also been talking about value of experiences, deconglomeration.
Yeah.
I don't think you coined that one, but close. Private markets versus public markets.
Yeah.
Is all that stuff still working?
I'd say there are a couple things that are changing. The kind of corporate carve-outs or deconglomerization, if you can get your mouth around that, that is really active. I mean, today the news on GE, you look in Honeywell. I mean, what's driving that? One is corporates want to improve their footprints. Two is there's a huge amount of money that's come into activism, and that's helping to move the footprints of global corporates. For us right now, that is really exploding in Japan. I think we've talked about this before. That market with big household names. I mean, the Nikkei 400, 25% of those companies have more than 100 subsidiaries, and many of them have more than 300. I mean, that's highly inefficient relative to Europe or the U.S. So that's an area where we're active. We certainly are doing more around experiences, things like travel, healthcare. I was recently in China. The environment, to me, now ranks almost as high as job growth in terms of government priorities. So that really will drive behavior. And then in private credit, which I know is an area we've also hit on before, we're seeing more opportunity today in performing private credit really against where their assets pledged against collateral. That could be housing, commercial construction, airplanes. As the banks are doing better, they actually want to sell some of their performing credit. We've been able to partner with them. That's really active for us in Europe. And those are good unlevered returns. I mean, in a world today where nominal rates are 2 or 3% in the US, less in Europe, and nowhere in Japan, if you can pick up an unlevered 8 or 9%, that's a very healthy return.
So let's rank order this, 1, 2, 3. If you look across the world and you compare the outlook, if you will, with valuations, where are you getting paid to take risk?
I think you're getting paid in the corporate sector around spinouts. You're getting paid in performing private credit. We're seeing some very interesting things in the MLP space. I'd say on the cautious side, growth in defensive stocks in Europe look expensive. To me, high yield generally looks expensive. And I think government bonds, in my mind, their goal in asset allocation is to do two things. One is to provide a coupon, and the second is to be a shock absorber. And I think we're entering an environment where they're going to lose their effectiveness on both those fronts.
Back to high yield for 1 second. Still looks expensive even after that sell-off.
I think I think that high yield can still back up from here. Yeah.